Hello and welcome to StockWatch Live. Now, barely a week goes by when we don't mention the retail sector in some shape or form, and this week is no different. Having recently sold £429 million of Sainsbury's superstores as it shrinks its retail property portfolio, investors will be watching for British Land's next move when it posts full-year results on Wednesday. And of particular concern will be British Land's ongoing exposure to the retail sector. The supermarket disposals are all part of a strategy which since April last year has seen British Land, one of the UK's largest listed landlords, sell almost £1 billion of retail property assets, its own share of which comes to £646 million. With these 12 Sainsbury's stores sold to New York listed Realty Income Corporation, it still leaves 1.8% of British Land's portfolio in superstores. Although that's down substantially from 2013, when supermarket stores made up 12.6% of its portfolio. However, what analysts have noted is that this latest sale leaves it with proportionally greater exposure to shopping centres and retail parks. This is again all in line with its strategy, but the fact is that values for these assets are declining faster than for supermarkets, and that's played out in British Land's valuations. While its superstore portfolio declined 0.7% in the first half of the current financial year, its multi-let sites, such as shopping centres, saw a 5.2% fall, according to analysts at RBC Capital Markets. Deutsche Bank recently downgraded its investment rating on British Land from buy to hold and cut its price target to 620 pence. For its part, RBC Capital Markets has initiated coverage of the company with a sector performer investment rating and price target of 550 pence. Let's stay with the retail sector and take a look at Kingfisher, which has first quarter results out the same day. Now, at the last outing came news that annual profits had more than halved, and it was looking for a replacement for Chief Executive Veronique Lowry, who was only 3 years into her 5-year turnaround plan. The One Kingfisher initiative, which was launched by Ms Lowry in 2015 with a promise of an additional £500 million boost to profits, saw that promise reneged on, with the explanation that the target no longer reflected the way the company's managed. Ms Lowry's departure, while arguably the most high profile, is only one of numerous management departures of late. Analysts at Investec say these have left Kingfisher in limbo, and the new chief executive likely to be handed something of a poisoned chalice, with the real challenge being to identify the longer-term growth story. Brokers' views on the stock are perhaps unsurprisingly mixed. RBC has repeated its underperform rating and raised its price target from 200 to 220 pence. SocGen has downgraded its rating from hold to sell, as has HSBC, which has also trimmed its price target to just 180 pence. The shares are currently trading at 252 pence. Now on to Centrica, and shareholders there will be keeping a close eye on what's said at the trading update on Monday, as they wait to see whether the British gas owner will cut its dividend payout in July. Consensus forecasts suggest Centrica will cut its payout by 25% to 9 pence at the interim results announcement in July. But HSBC says that's untenable, and the payout needs to be cut by 50% instead to 6 pence a share. In a note, analysts argued that a 25% cut would leave both insufficient earnings and cash flow to offset the effects of the mild weather in the first quarter. HSBC also downgraded its rating to reduce from hold and set a 90 pence target on the shares, which are currently trading not too far off at 105 pence. Finally, on Friday, it's the turn of Royal Mail to post full-year figures. Now, I think it's fair to say that it's not every day that industrial relations expertise is explicitly picked out for a reason to appoint a candidate to a chairman's role. But that's how Royal Mail has rationalised its decision to promote its deputy chairman and the chair of its Audit and Risk Committee to the position. His 18 years of experience at British Airways, where industrial disputes are commonplace, is clearly seen as a strength at a time when Royal Mail has signalled its intention to squeeze more efficiency out of its 140,000 strong workforce. At the beginning of last year, the company narrowly staved off its first strike since privatisation because of plans to close its defined benefit pension scheme. Expensive office space has been sold off, and now analysts say job cuts must be next on the list of cost-cutting measures. Efficiency is the name of the game for good reason, though. Letter volumes have been falling, and parcel deliveries, though increasing, haven't grown as much as expected because of an overcrowded market. As a result, Royal Mail shares have come under pressure since it listed in 2013. A profit warning in October caused a sharp fall in the shares. Keith Williams is due to take over the role this month from his predecessor Les Owen, who had only been in the job for 6 months when this new appointment was announced. Shareholders and board members alike will no doubt be hoping that Mr. Williams is made of sterner stuff. Well, that's it for this week. To follow the companies as they report in the week ahead, go to the Markets and Insights section at fidelity.co.uk. See you next time.